I call the last battle for gold between, say, 1310 and 1375. That's the battleground for people that don't want gold to break out and those that do, because I feel that once we get over 1375, we're probably going to go to a new high. That's probably going to signal the return of the gold bull market, and that's when the miners start to perform. But if you're buying gold, if you're buying miners now, just know that you're buying in an unhealthy market, and you have a lot of risk, because it's a tough market. If we can get back to get above 1400 and we get in a healthy market, and then from there up, then things could really start looking up. Once you get to, say, $1,600 gold, that's kind of the euphoria phase. That's when miners are just really printing money. But we got to get to, like I said, 1310 first. Below 1310, it's kind of ugly.
For millennia, ancient pharaohs prospered from unparalleled riches made possible by Egypt's resource-rich gold deposits. But despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. But that's all about to change. Aton Resources is leading the charge on the Egyptian mining revival. As the only public exploration company in Egypt, Aton Resources has first mover advantage. Focused on their 100% owned Abu Marawat concession, Aton Resources is advancing several exploration targets, including the recent discovery of the legendary Lost Mountain of Gold at Rod Ruin. Learn more about this exciting drill program and other news at atonresources.com. Aton trades on the TSXV under the ticker symbol AAN and on the OTC under the ticker ANLBF. Thanks for tuning in, ladies and gentlemen, and welcome back to another Mining Stock Education Expert interview. I'm Bill Powers, your host, and in this episode I'll be speaking with returning guest and professional mining stock investor Don Durrett of GoldStockData.com. Don's been investing in mining stocks since 1991. He's the author of the book, How to Invest in Gold and Silver, a complete guide with a focus on mining stock. It conveys Don's well-thought-out and tried approach to mining stock investing. So Don, it's been 9 months, but thanks for joining me again on the show.
Hey, Bill, nice to have me back. I just want to make one comment as far as a professional. The only way I'm a professional is I do have my website does charge for memberships, but that would be the only way I'd be considered a professional.
You have 17 or 18 years of experience as well, so you've learned a thing or two.
Yes, I have a lot of experience, that's for sure. I think my book on how to invest in gold and silver mining stocks is one of the best on the market. So.
And I told you, I think I've read it 3 times, especially as I was learning how to invest in mining stock. So I know your approach or philosophy to investment quite well. But for new listeners that haven't heard of you or you haven't been on my show in 9 months, I'd like for you to talk a little bit about the assumptions that you have on the future price of gold and silver, and how that affects how you decide to invest in certain mining stocks.
Oh, interesting question. That's the reason why I got into gold and silver mining stocks is because of my expectations on the price of gold. So I've always thought that the price of gold during our lifetime right now, there's kind of a once in a lifetime thing, that gold would spike. It would basically make this big move in conjunction with the bond market. So I associate the price of gold to the bond market, the global bond market, and the bond markets in the major countries such as the U.S., Japan, China, Europe. So the bond market for me is the trigger, if you will, for gold prices. So I've always thought that Keynesian economics has gotten out of control. And I was doing this back in the 1990s before things really got out of whack after we got to the turn of the century. Now everybody starts to recognize how crazy things have gotten with regards to debt. So I've been doing it. The reason I'm in gold mining stocks goes way, way back. I actually bought a gold mining mutual fund in the early 1990s. Because of the bond market and what it represents. So you have everybody, if you look at Exter's pyramid, gold is actually considered the safest asset you could hold, even above T-bonds or even cash. Gold is the pinnacle. So why is gold the pinnacle? Because it has no counterparty risk and because it's rare. So eventually, gold's going to spike. When it spikes, the miners are going to do extremely well. That's a long answer to your question.
And then with that expectation of a future higher gold and silver price, you use that to factor in the future market cap and profitability of the mining companies before you invest?
Yeah, and I created my website, which came out in 2012. The whole focus of it was how to value companies based on future future gold price and future valuation of a company. And I don't know anybody else that does this. So all of my valuations, my website shows you exactly what the future upside potential is of any company, any producer, and any company that's building a mine. So I basically calculate their future market cap based on their future reserves, and I multiply that by the future gold price, and then I multiply that by a few other things, and I come up with a future market cap value. And I compare that future market cap value with their current market cap value. And I use fully diluted shares to do that. And I'm only interested in companies that have returns of at least 300%, and I'm really focused on returns above 500%. So I'm basically projecting out, saying, okay, this is what I expecting the gold price to be. This is what I'm expecting the future cash flow to be for a company, and those are the ones that I buy based on a bunch of other criteria as well. So I'm very future oriented.
This year has been painful for gold and gold stock investors, as we were chatting about some of the challenges and losses that we've experienced in our portfolio, chatting before the recording started. What's your perspective on gold? With where gold is at now in the short and medium term, we know you have a bullish long-term perspective, but let's say in the next 1 to 2 years, do you see any solid for sure catalyst for gold that we can rely on for a higher gold price?
Everybody has an opinion about, all of the various macro data points, where they're currently at, where they're going. And it's really hard to predict, near term, what exactly was going to happen. But I would think that this business cycle is kind of getting long in the tooth. It kicked into gear. So we started having a growth cycle in, I think, June 2009. So we're 9 years into this. At what point do the markets roll over? I mean, last October, which we're now, what is it, November 3rd. So last month, we had a bit of a sell-off in the markets, and people are starting to get nervous. And we have Jerome Powell, the new head of the Fed, seems to be very, very bullish, and he keeps raising rates. And he said he's going to raise rates again in December. And he's going to raise rates again in 2019. And so we have these higher rates. I was just reading where the LIBOR rate, which a lot of corporate loans are based on, has doubled. It's went up 100% in the last year. So we have a lot of higher rates that people are paying. And so that's impacting the economy, which should create a fear trade in gold if the market sell off some more. So what I'm looking at right now, I want to see the markets go under the 200-day moving average, which is around 20,000 in the Dow. So that's quite a drop from here. We're at 25,000. But if we can go down under 23,000, I think you'll have enough negative momentum where we probably will sink under that 200-day moving average, and that would be kind of, and then if we stay under that moving average for a week or two, that confirmation should kick in the fear trade in gold. In between now and then, I would expect that to happen over the next 12 months. This sell-off that I'm thinking could happen in the markets, but you never know. Things could muddle on. The Fed could change course and they could lower rates and stable things out. But I mean, you mentioned this year has been, a really big sell-off in the miners, and it has. I mean, we have the HUI under 150. Anytime it's under 150, that is, really, really weak. For instance, it was over 600 in 2011. So HUI is the majors miners index. So the majors from here, if we got a new high, that would be a 3-bagger for the majors. So that's big returns. You're talking 300% on the majors on average. So some of the quality majors are going to go up 5x. And then, so we're basically bouncing on the lows. I mean, you're talking about those kind of returns. And the HY was at 100 in 2016. I don't think we're going to go back to 100, but when you're down at 100, I mean, that's just, you're talking all-time lows. That would be, 5x return for the average on the majors. So you can imagine the kind of returns that you could have in the mid tiers and the juniors. So we're kind of bouncing on the bottom. Once things turn, and I think the markets, and I talked about the bond market is crucial here. I mean, we're going to have to see where what happens to that, because if money flows out of the bonds into gold, that's when you're really going to have some huge returns.
Do you consider where we're at right now in the junior gold stocks a good entry point for somebody looking to allocate cash?
Yeah, I do. I think anytime you're under 150 in the HUI, that is kind of it's kind of like a fire sale type of situation. We're not quite at fire sale prices. You'd have to go all the way down to 100, which would be a 33% drop here. So there's potential. So if you bought here, you could be catching a falling knife, because I think it's possible we could go all the way down to 100 of the HUI. I don't expect it to happen, but we could easily go down to 125, 135. So you'd be catching a falling knife if you bought here, but it's still really, really cheap. But the thing about the miners right now is, anytime that I think to get to a healthy situation, we need to have $1,400 gold and $20 silver. When I say healthy, at $1,400 gold, basically the majority of your companies are going to be making money. Your producers are going to be making money, and your development stocks are going to be able to raise money to build. For instance, if you have an IRR of 25% or higher, you should be able to finance it at $1,400 gold. I mean, an IRR at $1,300 gold of 25%. So once you get to $1,400 gold, the banks are a little bit more, confident that those IRRs are going to hold. So we're not even close to a healthy market, and we're not going to be there. We're not going to get to $1,400 gold anytime soon. I mean, I would think maybe we could get to $1,300 in the first quarter next year. So we're a long ways away from a healthy market. So if you're investing today, you're not really going to get great returns in the near term. You're really investing for the long term. So anything that's under $1,200 gold, $14 silver, it's very, very unhealthy. So we're kind of close to that. We're like $1,230 gold, $1,450 silver. So we're really close to a very, very unhealthy. And right around $1,300 gold, $16 silver, that's kind of a struggling area. You're still not healthy. You're kind of struggling. So I'm looking for gold prices to get over around 1310, which was a really important area level that I wanted to hold, and we didn't hold it. I call the last battle for gold between, say, 1310 and 1375. That's the battleground for people that don't want gold to break out and those that do, because I feel that once we get over 1375, we're probably going to go to a new high. That's probably going to signal the return of the gold bull market. Mm-hmm. And that's when the miners start to perform. But if you're buying gold, if you're buying miners now, just know that you're buying in an unhealthy market, and you have a lot of risk, because it's a tough market. I mean, look at this year. I mean, it's been absolutely brutal because it's just been unhealthy, and that's just the way things have been. If we can get back to get above 1,400 and we get in a healthy market, and then from there up, then things could really, really start looking up. Once you get to, say, $1,600 gold, that's kind of the euphoria phase. That's when miners are just really printing money, and it can just get better from there. But we got to get to, like I said, 1310 first. Below 1310, it's kind of ugly.
Don, we were chatting pre-recording because of how difficult this year has been as investors regarding managing risk and quickly identifying losers. Can you speak regarding that topic as it relates to investing in junior resource stocks?
Let me start here. So down here because the one place that you're going to get bit by management teams, basically not executing, it becomes really, really hard to raise money and to make money down here at these prices. And so it's really, quality management teams really become important. And it's so hard, it's so easy for any management teams get exposed, if you will. So you see these stocks just crash. They just start falling because it's just an ugly environment, and any mistake that they make just gets magnified. So you have to be really careful. That's why I like to buy quality producers. Anything under the once you get down here, you can always buy stocks, cheap stocks. They're always going to be there. But when the HUI is low, that's when you can find quality producers that are on sale. So I tell people, you want to buy. This is when you want to buy producers down here. 125 HUI, 135, 145. This is when you want to buy the producers. And the reason why you want to buy the producers is because they're more reliable. So when the price of gold goes up, you can count on those producers to basically follow that market higher. They're less likely to dilute if they're producers. And they're less likely to go bankrupt. I mean, it's possible that they will. I mean, you have to look at their balance sheets of all, and you can just decide how much. You can look at their balance sheet and you can kind of decide, how much risk you want to take on. But those are the stocks that have huge leverage to the gold price because they get healthy very, very quickly. So if you look at the producers and look at the ones that have been selling off. And yeah, there's some risk there on their balance sheet, but you're taking a lot. You're getting a lot of leverage, a lot of bang for your buck, versus a development stock, which is not going to really perform as well as a producer once the price of gold goes up, because they still got to build that mine. So there's a lot of risk still there. There are stocks that have not been de-risked. Near-term producers are another one you can take a look at. But exploration stocks, those stocks are always kind of available, if you will, because that's all really about chasing results. But back to your point on management teams, it's so difficult in this to make money on exploration and development stocks. It's so easy to lose money. So you have to be really careful. So that's where you need to, I really think you need to kind of initially focus on producers because they have less risk. You can kind of manage your portfolio a lot better. And people like to go after exploration stocks, or they like to go after cheap stocks. And then they find out that the management teams aren't quite as exemplary as they were expecting. And then you see it really kind of, like I said, it really magnifies as the price starts to crash. So you got to be careful there.
And sometimes, as we were chatting beforehand, you can almost feel from the investor's perspective that it was like a bait and switch, where you read the MD&A, you thought you knew what the management wanted to accomplish with a specific property and resource, and then 6 months, 9 months down the road, it turns out to be something completely different.
Yeah, that happens more than we would hope in this industry. I've seen it on multiple occasions where it's kind of management is kind of leading you, kind of misleading you in what you're expecting them to do with the property, or what you're expecting them, what kind of decisions that they're going to make, how they're going to invest, how they're going to dilute shares, how they're going to raise money. And you think they're going to go one way and they go another. And a lot of times exploration stocks and development stocks too, they you think that they're going to, the plan of approach of how they're going to monetize that project is not how it ends up. I've seen a lot of development stocks, for instance, get sold at a low premium, and when they're first developing them, they give you this impression that they're going to build a mine, but they always say, well, we're going to be open for offers. But then they end up, the management, these aren't hostile takeovers. The management team will accept a 40 or 50% premium, but they sell down here at the bottom of the market. Well, those 40 and 50% premiums, those can be made up in a week if the price of gold goes up. So it's like, wait a minute, you said give me a 40% premium, and then the price of stock goes up 40%, like a week or a month later, just because of the price of gold went up. So you never get they never will factor in the future price of gold. That's what drives me nuts. Is so if you factor in the future price of gold, you're practically giving these projects away. And I see that happen so often. It really frustrates me because the company that does the takeover ends up with all the value. I hate to name names, but there have been stocks that have dropped 70, 80, 90%, right, this year alone. Maybe not 90% this year, but I mean, we've seen 60% move, 70% down this year alone, and definitely over the last 2 years. And so if those companies, if they sell at a 40% premium, everybody that bought the stock a year ago is going to lose money. So how does that help shareholders, long-term shareholders? And you see that happen a lot. So it's just a really, really risky thing. And so, it's hard. And anybody that's got into this business and has bought these shares and for the long term has went through this, where they've basically seen dilution, their value get really, really diluted. And these companies are going to kind of use it as kind of like a bank where they can print money. And so that's just part of the game. And that's where you have to, like I said, focus on the producers because they're not going to dilute as much, and their management teams are a little bit better quality. Focus on those, and then use the juniors as more of a kind of a speculation stock, and so you don't invest as much. For instance, in my book, I say that absolutely the most that you want to invest on a high-risk junior is 1% of your cost basis. And that's the upper end. You really want to do 0.5%. Or you can even go lower than that, 0.5%, so that if the stock does go south and you lose 60, 70, 80% of that stock, that you're not as exposed.
You like the growth-oriented mid-tier producers within that, $100 million to $400 million market cap. Have you looked into some of the growth-oriented royalty companies like Sandstorm, which is a sponsor of this podcast, but those companies also seem very attractive at these levels? Yeah,
it's a good question. I've never been enamored by the royalty companies, the royalty model, even though it makes so much sense. I mean, I analyze stocks, I analyze at least 10 stocks every week, and I come across a lot of royalty companies. I have 800 stocks in my database, and they're all the gold and silver miners and the royalty companies, just about every one, in the world with a market cap over 3 million. So I analyze a lot of royalty companies, and I analyze a lot of stocks that do deals with royalty companies. And just yesterday, I was analyzing another one. And these deals are always one-sided for the royalty companies. The one I did yesterday, a company gave a company $55 million, said, here's your $55 million, and now I want back approximately 12% of your production, and I'm going to get the maximum I'm going to pay you is $600 an ounce. That's the maximum. And I'm going to pay you 30% of spot until it gets to the maximum. So they're going to start out, at $1,500 gold, they only have to pay $500 an ounce. At $1,200 gold, they pay $400 an ounce, or a little bit more than that, maybe $450 an ounce. So they're paying for the gold. They're making back a boatload of money on that $55 million. Now they say they take the risk because maybe they don't get some of this money back if they don't go into production. But when you got those type of margins, it's a good business to get in. I mean, and these are locked in prices for the life of the mine. So, the royalty model, I mean, it's fantastic. And as a matter of fact, I'm seeing a lot of project generators switch over to the royalty model.
Or they're a hybrid. There's a lot of hybrids emerging now between the prospect generator / royalty company.
Yeah. And I know two off the top of my head that have just converted over to the royalty model, even though they have, a lot of exploration properties that they own. So you can call it hybrid, but they're actually calling themselves royalty. And the reason why is because the margins are so high. And it seems to make a lot of sense. But I personally have never been enamored by it, and I have not bought any royalty companies just because there's just something about that model that just seems so one-sided. It just doesn't sit well with me. I just think that when the price of gold goes to 2,000, that something has to give on these models. They're just so one-sided. We'll see what happens because they're all fixed. It's like, there's a couple things in the mining business that to me are just kind of, don't make a lot of sense. And you just see this a lot in capitalism. Things are just kind of get one-sided. And one of those is this model where you kind of get fixed prices. The other thing that I mentioned it earlier is this whole mindset that the price of gold is never going to go up, that I'm not going to value my company based on future prices. Those are two things in this whole business that just is kind of unsettling to me, but it's just part of how things work. But you can kind of use it to your advantage. For instance, if they're not going to use the future price of gold, I'm going to do it when I value these companies. But as far as looking at investing in the royalty companies, I think it makes sense if you're just looking to make, say you're just looking for returns. If you're just looking for returns, this model makes a lot of sense because they have great margins. So I'll just end my answer there.
Yeah, and I would just point out too that there's also the exploration upside, often free exploration upside with this model because they have, the royalty on 700 square kilometers, and the company that they have the royalty with, the agreement with, discovers another deposit or increases the ounces of gold by 5 to 10 million, and that's all free cash flow to the royalty company. So you do get some of that exploration upside with a good structured royalty company.
Right. True.
So I'm curious, we haven't spoken in 9 months. As an investor, what have you learned? What stands out the most in your own development and growth as an investor over the 9 months that you'd like to share?
Gosh, I guess I should write another book or I update mine. The one thing I've learned, this has been a really good interview. I think there's been a lot of good stuff I've shared. I would just go back and repeat. The one thing that I've learned, and this goes back, you said 16 years, and that's about right. The one thing that I've learned is that you want to diversify and focus your portfolio. If you're a long-term investor and you're looking for returns, you want to focus on the producers because they have more reliability on the upside of price of gold. It's reliable in that, for instance, First Majestic. I'll just give one example. I haven't mentioned one company name in this whole interview, but First Majestic Silver. So if the price of silver goes to $25 tomorrow, First Majestic Silver stock is going to go up at least 25%, maybe 50%, because that movement up in the price of silver, it makes First Majestic, it reduces their risk tremendously, because now it's at $25 silver, they have cash flow. So their balance sheet, it got better overnight, so they have more profit, and any debt that they have on their balance sheet the risk just went down. Now they have, in addition, their company just got stronger in that now they can start looking for acquisitions. So a producer gets healthy in a number of ways. Whereas if you're a development stock and you haven't built your mine and you're still permitting it, and the price of silver just went up, you just got marginally more valuable. But you didn't really de-risk your project because you still have to permit it, you still have to finance it, and if you're an exploration play, you became marginally more valuable, but not nearly as marginally more valuable than a producer. So you really want to have a lot of producers in your portfolio because those are the ones that are more reliable, have more upside to the price of silver. They become marginally more valuable, and that's what I've learned. That's where you're going to make your money. So let's say that the price of silver goes to $100. you can imagine how much marginally more valuable a producer such as First Majestic Silver is going to be, or Pan American Silver, Endeavor Silver is going to be if the price of silver goes to 100, because all that value, all that price of silver, it just goes right to their bottom line. Everything that I just mentioned becomes, marginally more valuable. Whereas if you had a development stock, if you had an exploration stock, and it just doesn't transfer over to the value of the company. And one final thing I want to make about what you're looking for. Okay. Don said that you want to be buying producers down here at HUI 150 or below. You want to look at what is the cost structure. So you really want to look at for gold. I mentioned silver producers. You want to look at all in cost around $14 or $15, and that's free cash flow, if you will. And gold producers maybe around $1,100, $1,200 or below that. But anything that you have all in cost above those, becomes more, you're adding risk. Yeah, they have a lot of leverage, but the risk goes up. So you want to be looking at these these cost points. Where is kind of the where does the leverage really kick in for these companies? So you want to be looking at that, and then you want to be looking at their growth structure and the life of their mines. You don't want to be buying companies who don't have long lives. You're looking at 10-year plus mine lives is what you want to be looking at. So you want to be looking at the growth potential. What's in their pipeline? Are they going to be growing? Are they stuck? Are they stagnant? You want to look at these things. And that's kind of that's not a all-encompassing look at how to look for a producer. That's just some of the points, some of the higher level points, if you will.
Don, for listeners that aren't familiar with goldstockdata.com, can you give a quick overview as we conclude?
Yeah. Thanks for offering that. So I'm as you guys know from listening to this interview, I'm an investor in gold and silver mining stocks, and I was before I created the website. So the website is created by an investor, and it's designed to help you find stocks. So I have a search engine, so I have 800 stocks in there. The most powerful feature in Gold Stock Data is the search engine. So you can search by just about anything. You can search by cost. You can search by upgrade potential. You can search by category. If you want to see all the producers, all the near-term producers, you can do that. And I've broken the companies into like 10 different categories. So the search engine is very powerful. And it's not really, my website is not built for people that are new to this, although if you want to get into it, you can. It's really made for people that kind of have a little bit of understanding, so they want to go and look for stocks with potential. So I really created for like myself. Okay, so I'm back in the early 2000s. I'm a gold and silver mining investor. I want to find stocks, but how do I find them? So this search engine is what I created, so people can find stocks. So like, okay, I want to find all the silver producers. That's what it's for. That's who it was created for.
All right, well, Don, I appreciate the conversation. Thanks for stopping by and sharing your insights.
Let's do it again in 6 or 9 months, Bill.
Sounds great. Have a great day. Thank you for listening to this Mining Stock Education podcast. Please subscribe and share with like-minded investors. Visit us on the web at miningstockeducation.com for more resources on precious metals and natural resource investing. At our website, you can also sign up for our free newsletter for interview transcripts, stock picks, and more.